Howdy, Jacob here. Today we're looking at Emerson Electric Company in the electrical equipment industry. 63 billion market cap, just under 68 billion enterprise value. They are a technology and software company that provide various solutions for customers in industrial, commercial, and consumer markets globally. Incorporated in 1890, headquartered in St. Louis, Missouri. So their revenue growth is actually down from 10 years ago. I'd like to think there were some sell-offs here, but we are seeing back to more positive revenue growth a bit more consistently recently. Gross margin is a bit higher, operating margin actually down a little bit. Their dividend is up slightly, so they have increased it every year for the last 9-10 years, but very, very marginally. In relation to their earlier earnings per share, it is quite a bit, over 50%, but the most recent year where they had a massive earnings per share jump, it looks like nothing. So we'll see on the free cash flow what that looks like. Return on invested capital, pretty solid. Has not been single digits all the last 10 years. It's been double digits, minimum of 10.9%, all the way to the most recent year of 35%, but averaging maybe 11 to 14%, which is pretty solid. Pretty good return on the money reinvested back in the business. $8 billion for cash on hand, with $7.6 billion long-term debt, $547 million short-term debt. Definitely not concerned with that balance sheet. Although they have $7.6 billion in debt, they have more than that in cash. Their cash flow statement shows one sell-off here in 2015. Outside of that, though, there were more acquisitions in quantity of dollars than devastations. And so it is interesting that they still had some revenue declines outside of 2015. And they made a large net acquisition over here of $5.7 billion. And even the most recent rolling 12, $8.2 billion, in which I can't really see exactly where they funded it by, because it should have been, there's this other category. So maybe there was some sell-off of investments, but I guess I should be able to see that on the balance sheet, which I don't. So that'd be something I'd look into. Looks like they actually, there's investment over here, probably from the acquisition, it looks like. But their use of cash is mostly dividends, share repurchases, and then quite a bit of net acquisitions. So when they see an opportunity to make an acquisition, they put in quite a bit. They put in about 1 year's free cash flow every couple years to buy a large net acquisition. So let's get to it with assumptions here. For as big a company as it is, let's see, we have, I think revenue growth at 3% makes sense to me. I think that a margin over here, 12, 12, 11, 18, 23, 14. I'm going to be a bit more conservative and say it doesn't necessarily be at that 18 to 23 levels, but their gross margin is up from 10 years ago, and that's what's really going to have you push those margins. And so I think a 14 and 13% for earnings and free cash flow makes sense. Share change, 1% for them is about 600 million. With your stock-based compensation, you're looking at about 800 million. I think if you cut it in half, 400 million seems more realistic to me, given that their dividend is paying out as much as it is and their acquisitions are as much as it is without going into debt. So I'm going to assume 0.5%. With terminal PEs, definitely 15% growth rate. Terminal PEs just under market. Since they're a large company, I think they deserve pretty darn close to market average, but I think their growth is not quite there. And although their return on invested capital is great, all they're doing with their money is buying back shares and paying a dividend. So it doesn't really require the premium that you'd give to a company that has a high return on invested capital and is reinvesting to possibly get those historical rates of return. So based on my assumptions, it is quite overvalued, needing to fall 68% before you get the return I'm looking for here. So this is going to be a company I'm going to be a bit more patient on until it gets to a more attractive price. Hope you enjoy.